very warm welcome to all my dear students. Let me start with another accounting standard in the series of revision, Accounting Standard 29. Basically, a very small and theoretical standard. There are few questions which obviously are raising doubts. We'll just discuss each of them, those questions, because this standard is relatively very easy. The important points which you should remember is what is a provision and recognition of a provision, what is a contingent liability, and contingent asset. Okay. Now first of all friends, remember that when we talk about this accounting standard and I say provision, I am dealing with provisions against liabilities. Of course, the provisions which are created against assets are not covered by this accounting standard 29, like provision for depreciation, provision for RDD, that is nothing but doubtful debts. This is not covered by this accounting standard 29. What is covered is nothing but provision relating to liabilities. Now, first of all, what is a provision? You already have the answer. Provision is a liability which requires substantial degree of estimation. It's a liability which requires substantial degree of estimation. Okay. Now, when I say liability, it means there will be an outflow of resource to settle that obligation. Hence, there are three conditions which are to be fulfilled for recognition of a provision. If all these three conditions are fulfilled, then only we recognize a provision. Like, I have sold goods to you, and at the time of sale, I have given you a warranty that if there are any kind of repairs, I will make the repairs free of cost, or I will do the repairs free of cost. That is my commitment. Now, my dear students, don't you think I have a present obligation as a result of past event? That is the first condition. Today I have an obligation. The moment I sell, there is an obligation. Present, that is nothing but on the balance sheet date, say 31st March. And this obligation has arose because of past event. It is probable means more likely than not. Means more than 50% chance is there. What is more than 50%? That there will be outflow of resources, embodying economic benefits to settle that obligation. And the third, you can measure it reliably. Now, my dear students, if all these three conditions are fulfilled, then only we will recognize a provision, like provision for warranties, provision against litigations. Don't say provision for tax, because that will be covered by AS 22. So, basically, my dear students, this all standard means not all standard, but this basic standard is dealing with what? It deals with creating provision against liability. Or I can just say in a nutshell, a liability which requires estimation is nothing but a provision. Obligation is certain, but the amount requires estimation. Amount is uncertain. That is nothing but a provision. So, provision for warranty will be recognized, provided all these three conditions are fulfilled. Now, the question comes, how to measure that provision? So, standard makes a very simple point, don't discount it to its present value. Yeah, no discounting allowed. You can't say, sir, warranty is I have to do repairing work after 2 years. So, what is the present value of the amount which will be paid after 2 years today? That is not to be done. So, the standard is very clear, no discounting to its present value. And of course, you are not supposed to create provision for future expenditure. Only if liability exists today, obligation exists today, then only we have to create a provision. You cannot say in future this expense will be happening, so let's create provision. No, because the point was very clear, arising from past event. Review of provision, it's nothing but the amount is measured every year, then we have to find out whether the measurement principles are correct or not. Then comes reimbursement right. Within provision I am talking. What is a reimbursement right? Nothing but somebody is going to pay me compensation for this provision. I have a right to get reimbursement for the provision which I have created. So standard says you should recognize this reimbursement right as a separate asset provided it is virtually certain that you are going to get that. Then only. Otherwise no. If it is virtually certain, then only we should recognize it. If it is not certain, then no reimbursement right is to be recognized. It is to be shown as a separate asset. Of course, in P&L, you can net it off. Thereafterwards, friends, I come upon contingent liability, my dear. See, basically, contingent liability, let me write it this way. Either it is a present obligation or it is a possible obligation. Present obligation or possible obligation. Present obligation but not recognized. Why? As it does not fulfill condition number 2 or number 3 of provision. If you remember, in provision you had 2 conditions, 3 conditions. It has to be a present obligation. It is probable that there will be outflow of resources embodying economic benefits to settle such obligation, and it can be measured reliably. So condition number 2 or condition number 3, that is not getting fulfilled. So if condition number 2 or 3 is not getting fulfilled, then don't recognize it. Yeah, present obligation but not recognize it as it does not fulfill condition number 2 or number 3 of provision. Possible obligation. Possible obligation. Today there is no obligation, it is possibility. Yeah, if it is a possible obligation, arises as a result of past event, the existence of which will be confirmed on occurrence or non-occurrence of one or more uncertain future events which are not in the control of the entity. So if it is a possible obligation, then we say it is a contingent liability, or it is a present obligation. I wrote here present obligation. It is not recognized because it is not probable. See, this is nothing but condition number 1 and 2 is as good as condition number 2 or 3 of provision. We don't recognize. Contingent liabilities are not recognized. When I say it is not recognized, what does it mean, friends? It means that it will not find place in my financial statements. It is just disclosed as a footnote. Yeah. Unless the possibility of outflow of resource embodying economic benefits is remote. Then comes contingent asset, the last area of discussion. Possible asset. Here we had possible obligation, here possible asset that arises from past event, the existence of which will be confirmed on occurrence or non-occurrence of one or more uncertain future events which are not in the control of the entity. Yeah, that is nothing but contingent asset. What should we do? We are not going to recognize it in our financial statements. Neither they are disclosed in financial statements. They may be disclosed in the director's report. Yeah, and not in financial statements. Okay, friends. So this is the stuff with respect to AS 29. We will not go in depth of it. Let's move on to some question answers. We'll begin with homework section. one of them, and then I'll go for past question examination. This all questions have been done in the class, so I'm not doing those classwork questions. You can refer those classwork questions. Of course, this question number 1 of homework section is also done in the class, similar to classwork, I can say. Yeah. Question number 2. An airline is required by law to overhaul its aircraft once in every 5 years. The Pacific Airline, which operates the aircraft, does not provide any provision as required by law in its final accounts. Discuss with reference to relevant accounting standard 29. I have to overhaul. Overhaul is nothing but service. When should I service? After completion of 5 years. Or I can say not completion, once in 5 years, anytime. The company is not providing any provision. Do you agree with the accounting treatment? My answer is yes. The company is not supposed to recognize any provision. The reason is there is no present obligation. See, that is the first condition. There has to be a present obligation arising as a result of past event. You don't have a present obligation because I have to overhaul once in a 5 years. Or it may happen that after 3 years I may sell off the aircraft. Do I have an obligation to overhaul it? Answer is no. So, provision is to be recognized only when you have a present obligation arising from past event. There is no present obligation, but it is a future. So, not recognized as provision. Clear? Of course, this is possible, that if 5 years are over, then you might have a provision or an obligation to pay fines or penalties. Okay, so these are similar, means I need not. Question number 3 was a question which everybody feels is difficult, but my dear students, it's very, very easy and very simple. Only the language is problematic. I will just solve this question number 3 of past paper, and you will find that yes sir, this is very, very easy stuff. Nothing big stuff is there in question number 3 of past paper section. Messrs AB Limited is in the process of finalizing its accounts for the year ended on 31st March 2015. The company seeks your advice on the following. The company's sales tax assessment for the year 12-13 has been completed on 14 February 2015 with a demand of 5.4 crore. The company paid the entire due under protest without prejudice to its right of appeal. The company filed its appeal before the appellate tribunal, that is authority, where the grounds of appeal cover tax on additions made in assessment order of 3.7 crores. The second point is, means it's not related to the first point, it's an independent point. The company has entered into a wage agreement in May 2015, whereby the labor union has accepted revision in wages in June 14. The agreement provides that the hike till May 15 will not be paid to employees, but will be settled at the time of retirement. The company agrees to deposit this arrears in government bonds by September 15. Now friends, first part, the sales tax assessment order. Now see friends, let's discuss that small point. What is my financial year? My today's financial year is 14-15. I have received assessment for 12-13. Obviously, I file my return, then only assessment happens. So, my current financial year is 2014 and 15. And in 2014-15, I have received a demand. Government is asking me to pay 5.4 crores. Now, first of all, government has asked me, pay 5.4 crore. should I recognize a provision for it? I say no. What did I do? I received a demand, so I have challenged it. But if I go for challenging the government, the higher authorities will accept my challenge. Yes, let's fight. You are in a court or a commissionerate, then you can go to tribunal and high court and supreme court. Yes, there are layers of appealing. But they say first you pay us the amount and then you appeal. So I challenged the same. But before the challenging the same, government says you first pay 5.4 crores. Of course, this is not accepting the government's demand. I say I am challenging your demand, but revenue people have to make themselves safer. So they say first you pay, then you come for appeal in the court. So I am paying 5.4 crore. That is not settlement of a liability. That is nothing but my rights. See, the company paid the entire due under protest without prejudice to its right to appeal. But challenge the same for only 3.7 crore, which means out of 5.4 crore, I agree for some amount and I disagree for 3.7. So now my friends, what will happen? As far as 5.4 crore is concerned, I have paid. This is paid, so treated as advance. That is an advance basically or settlement amount. But if you look properly, 1.7 crores, that is nothing but difference between 5.4 and 3.7 is nothing but to be treated as liability because I have agreed. I have agreed, yes, that you have asked for 5.4 crore, I agree with 1.7. So this is obviously included. You don't have to pay 1.7 by the way. Why? Because you have already paid 5.4, in which 1.7 is already included. So 1.7 crore will be recognized as a liability. I will pass an entry profit and loss account debit to liability. That is 1.7. I paid the amount, so advance account debit to bank 5.4. Out of this 5.4, 1.7 will be adjusted for the liability. The remaining amount which I have paid, 3.7, is nothing but the advance that I have to fight. But now, don't you think this is possible obligation? So 3.7 crore is contingent liability. That this may also become contingent liability. This may become liability, not contingent liability. I am saying this is a contingent liability. It may become actual liability later. Only this much, my dear, nothing big. Huh? Since the company is not appealing against the addition of 1.7 crore, same should be provided expensed off in the accounts ending on 31st March 15. So in 14-15, we will recognize this as a liability, profit and loss account debit to liability, expense off means P&L. However, the amount paid on under protest can be kept under the heading long-term loans and advance. So this amount is nothing but my long-term loans and advance, 5.4 crore. Short-term loans and advance, as the case may be. Contingent liability, you will disclose how much? 3.7 crore. Done? Okay. Now the second part. The company has entered into a wage agreement in May 15, whereby the labor union has accepted revision in wage from June 14. The agreement provides that hike till May 15 will not be paid to the employees, but will be settled to them at the time of retirement. The company agrees to deposit the arrears in government bonds by September 15. Tell me, friends. Nothing. From June 14 to March 15. See, our year is 14-15. We will provide it based on the assumption that the conditions with respect to this wage hike was existing on the balance sheet date. Yeah, so the whole amount will be provided in the accounts. I hope it's simple now. These are all things which are repetitive. Okay, one more question which many students have been asking as doubt. With reference to AS 29, how would you deal with the following in the annual accounts of the company at the balance sheet date? An organization operates an offshore field where its licensing agreement requires it to remove oil rig at the end of the production and restore the seabed. 90% of the eventual cost relate to removal of oil rig and restoration of damage caused by building it. And 10% arise through extraction of oil. On the balance sheet date, the rig has been constructed but no oil has been extracted. Second is, during 1617, ACE Limited gives guarantee of certain borrowings of Brew Limited, whose financial condition at that time is sound. During 1718, the financial condition of Brew deteriorates on 31st March 17. 31st December 17, it goes into liquidation. My balance sheet date is 31st March 17. Now see friends, the first part. You are operating an offshore field, nothing but oil rig. We are extracting oil from sea. I hope you are aware of Mumbai High. Nothing but we have floating platforms. They are referred as oil rigs. We extract oil from the seabed. Okay, so we have to construct a structure. The law says that once you have extracted the oil, you have to dismantle the structure. And whatever pollution or whatever deterioration you have done because of removing the oil, you have to see to it that the same is restored. Now, so obviously the moment I construct the oil rig, I have an obligation that I have to remove the oil rig. And whatever pollution has been done with respect to removing the oil, I have to even incur the cost to restore that. So my 90% of expense are pertaining to what? My 90% of the expenses are pertaining to dismantling. Now, if you look properly, on the balance sheet date, rig has been constructed, which means I have an obligation to remove the rig. So I will recognize a provision today only to the extent of 90%. You will say, why sir? Why not that oil expense you are not recognizing? The reason, I have not yet removed the oil. Because the question clearly says 90% is towards removal of oil rig and 10% is through extraction of oil. The oil is still not extracted. Means there is no obligation. There has to be a present obligation. Na? If there is present obligation, then only we create provision. So there is no present obligation. Yeah friends, so here's the solution. The construction of oil rig creates an obligation under the terms of license to remove the rig and restore the seabed, and thus it is an obligating event. And the balance sheet date, however, there is no obligation to rectify the damage that will be caused on extraction of oil. As no oil has been extracted on the balance sheet date, so no provision is required for cost of extraction of the oil on the balance sheet date. 10% of the cost through extraction of oil are recognized as and when liability will arise. Now comes second point. In 1617, ACE Limited gives guarantee of certain borrowings of Brew, obviously contingent liability. Brew has been declared insolvent on 31st December 17, but my dear students, even though the Brew is insolvent on 31st December 17, I need not recognize any kind of liability on 31st March 17 because there is no obligation on me. It is contingent liability. As per AS 29, liability to qualify for recognition, there must only be not only be a present obligation but also probability of outflow of resources embodying economic benefits to settle the obligation. The obligating event is giving the guarantee by ACE Limited for certain borrowings of Brew, which gives rise to obligation. No outflow of benefit is probable on 31st March 17 and hence no provision is recognized. It is disclosed as a contingent liability. In 1718, obviously, provision will be recognized. Why? because Brio has been declared insolvent. So I will recognize provision for 31st March 2018, but not on 31st March 17. Yeah, friends, so you may just have a glance over it. This is what questions I feel are somewhat of troublesome. So I just took all these questions in revision. Yeah, this much from my side. Thank you very much.